Okay, thank you all very much for coming to this lovely conference from XTB. They have invited a lot of speakers. And today I'm going to be taking a bit of a, thank you very much. Today, does everyone have one of these feedback forms? Because we'll be needing them later on. If not, I'll leave them right here. Now, today's presentation, my presentation, actually, it's going to be a bit different to what you have heard so far. And it's going to be different because I'm going to be saying uncomfortable truths instead of comfortable lies. So, I'm not talking about profitable trading. It's not going to be about patterns that will make you millions, but it's about the truth. Today's presentation is why traders lose. All the things you wish you knew before you started trading. One of the most often asked questions I get is, what do I have to learn in order to trade? I mean, what are the necessary knowledge, what I have to learn? So the first thing I ask people to learn, to actually read, is a paper, an academic paper called The Cross-Section of Speculator Skill. It's written by a Dr. Barber and Terence O'Dean by Berkeley University in the United States. What Dr. Barber and Dr. O'Dean did, they did a study. They took data of 360,000 traders, and they took the data for over a 15-year period. And what they did is study their performance. What they found was the following. 87% of traders, net of fees, lose money. 0.28% make money consistently. So the popular adage about 90% of traders losing money in the markets, well, it's a bit over-exaggerated. The actual number is 87%. So this is the first thing I ask people to read. But it gets much worse. Because from my experience, what I found is the rule of 90. Not only people lose 90% of their money, but they also lose, not only 90% of the traders lose money, but they also lose 90% of their portfolio within 90 days, especially referring with the ones that are doing leverage investments. So it's much worse than Terry O'Dean's study. And 10% actually go them bankrupt because they over-leverage. And I hope this tidbit serves as a crude awakening for everyone that wants to enter the arena of trading. I would kindly ask you to put aside all that you have listened or known so far and focus on risk rather than Ferrari fantasies and tropical island syndromes. I'll be trading from home with my PJs. Let's focus on risk and reality. Okay, why is it that bad? Someone may ask. Here's a study by Black Star Funds. So we're talking about institutional level research, right? And it's called the capitalism distribution. I think you probably can Google that paper. Basically, what they did, they took observations of individual common stock returns from 83 to 2007. If you update the data, their conclusions haven't changed that much. So what did Black Star funds find out? Like, I'll spare you the details. Sorry, this is the actual graph. It's a long paper. I just took a snapshot of one paper, and I'll put it here. Basically, what they did is they put in bins the returns of each stock for this period of time, how much lost 75%, how much lost 75 to 50, how many lost 50 to 25, minus 25 to 0, and so forth up until so you've got the worst stocks, the return of the worst stocks, up until the best stocks. Now, there is a lot of data in this one and what you can find, but I'll give you the four most important nuggets. 18.5%, that is almost 20, 1 in 5 stocks, within this period lost 75% of their value. Okay? So there goes the myth of buy and hold. 1 out of every 5 stocks was a horrible investor. I mean, basically, you would never recover your money. That's 1 in 5. 39% of these stocks, and sorry, we're talking about the US market, the Russell. So 39% of stocks had a negative lifetime total return, which means 1 in 5, you would never recover your money. 2 in 5, you would be in the red. 64% of these stocks never beat the index. So, minus 75, negative. These were positive, but didn't beat the index, which means if you were holding a mutual fund, or if you were holding an ETF, or any kind of diversified index-linked investment, you would be better off than doing your own stock picking. And 20% had huge winners. So, there goes stock picking. And maybe that helps explain a bit the 90% rule, which means the markets are a very, very difficult arena, but that's half the story. It gets even worse. The worst part is that we come unprepared into this arena. That's the problem. Because everyone comes for the easy money, the fast money. Okay, next question. And also, basically, I've put this as, because I get this asked often enough. I mean, why study the rule of 90? Why study the losers? Why not study the winners? I mean, that's what logic would dictate, right? That's what you've got the Schwager books, the market wizards, or the super hedge fund managers. You try to emulate these. But I would take a different approach to this one for the following reasons. First of all, foolish people don't learn from their mistakes. Clever people learn from their mistakes. But wise learn from the mistakes of others. So I think it's quite wise of us to learn what are the reasons behind the people that are part of the 90% statistic. But there's one more reason. There are many, many trading styles that can be profitable. But luckily enough for us, the types of mistakes that traders do are very small in number. So it's easy to improve our return by avoiding some mistakes and then learn what to do. For those that haven't, oops, wrong photo. For those of us, are there any MTA members or MTA people have attended the MTA meetings here today? Great. 3, 4, 5. See some hands there at the back. Probably have about 10 people. In any case, for those that don't know the MTA is the largest not-for-profit organization globally on professionals on technical analysis. It's a not-for-profit organization. It's based in New York, but it's all over the world. It's got around 4,000 members. And about 1,000 of them are certified with the CMT. It's the Technical Analysis Designation, which is recognized by the United States regulatory authorities. Now, we have a chapter here in the UK, which I'm very honored to be chairing for the past 6 years now, since 2010. During my tenure as chairman of the chapter here in the UK, I have been, how I call this, blessed to have met probably the greatest technicians on the face of this planet. People like John Bollinger, who was actually the one that recommended I take over the chapter, or Tom DeMark, who was an advisor for George Soros and Paul Tudor Jones. Now he's working with Steve Cohen and Leo Cooperman. Linda Raschke, you probably know her, she's the original market wizard in Jack Schwager's book. And Martin Prink, and many, many others. Now, why am I mentioning this? Because after having met and spoken and exchanged views and emails and calls and basically learning from them, and I'm actually talking about learning from them, not their books, I started making some observations about them. And the observations were the following. A, they were they had a quite varied number of approach to the market. You know, Linda's was quite different to Martin's, and Tom's was quite different to Tom's. John's was quite different to Tom's. They had quite varied approaches. On a personal level, though, all of them were very relaxed. None of them was a diva. But another thing that struck me as very, how shall I say this? I thought it was counterintuitive. Although they were using different methodologies, all of them shared the characteristics of discipline and confidence. All of them were disciplined and confident. And that, of course, started making me wonder, how can people using different techniques end up being so confident about using different tools and different approaches to the market? And my conclusion was because their confidence and discipline came from a process, not just what they knew, but how well they were doing it. So my next step was, can we emulate this? Is it reproducible? Is it transferable? Can we teach this? Can we set up a process when people can learn how to become disciplined and confident in trading? Because I think these are the two main battles. People scared to pull the trigger and so forth. So I started for the past couple of years and a way to model this. And here's my approach to it. Obviously, because we have limitations of time, we'll be taking this just on a definitional basis. And Eric is here. Eric mentioned that we'll be doing a workshop with XTB. Actually, we'll be doing 2 workshops with XTB to elaborate on this. Because today we'll be talking about why traders lose. On these workshops, these are free of charge. I mean, I'm just a guest speaker. There is no charge for it. We'll be going into how traders win. So today's presentations, why traders lose. All right, but let's approach this internally. The iceberg. What we see is, for example, people lose is the result, a behavior, people losing money. But below that, what we don't see is their feelings. And below that is their thoughts, and below that is their beliefs. And that's what's the generation of, from a psychological point of view. We have beliefs which create thoughts, and these thoughts generate feelings according to external events, and then these give rise to a behavior. So we'll be trying to analyze all these aspects. This is my idea of how we can analyze this. This is the stages model, how people trade, how traders develop in 4 stages. I've borrowed these 4 stages from a gentleman in the US called, I don't know if you've got the levels of learning on conscious incompetence. And basically, whatever we try to learn, we do it in 4 fashions. The first step is unconscious incompetence. We don't know that we don't know. We are unaware of our ignorance. The second level is conscious incompetence. We still don't know, what we should be doing, but we are aware that there are things to learn. The third level is about conscious competence, which means, yes, we have got the necessary knowledge and skills, but we're still thinking about it. I mean, we're quite deliberate about it. And the fourth is unconscious competence, which means it's kind of second practice, like a basketball player shooting the last second shot. He's taking this drill so many times, he's able to score at the basket without even thinking. Within these stages are the things we have to be learning, the skills we have to be picking up. It's an acronym S.M.A.R.T. And I think it's very important to be sequencing what we have to learn and in which order. So we won't have a scattergun approach into this article, this book, this course. Let's sequence these. Okay, so on the left, why traders lose? On the right, how traders win. How traders win, I'll be just giving the definitions. Like I mentioned, we'll be doing the workshops. Again, they are free, there's no pitch. They are free workshops. And actually, there'll be 2 of them because the people already signing up. All right, how people start? Usually they start with trading is an exciting game. We'll put £500 in our account, and then we'll start trading with that. And hoping we can make it into 20 or 30 or 50 or 50,000 pounds. And that's basically the equivalent of over-harvesting if you're a farmer, like having a small plot of land and hoping that you will make hundreds and thousands of tomatoes or cucumbers or fruits and vegetables. You've got just 400 pounds in there, that's it. People obviously lose that. Then they go to the next stage. The next stage is they put some more money into the slot machine. At this stage, trading is just purely charity. I mean, you're putting in money, you're losing it, it's purely charity. Then it comes the too smart to trade syndrome. People who have had some success in their professional life, being self-employed or executives, or they have amassed maybe a bit of wealth. They feel very comfortable in their profession. They usually get the mentality of, oh, success is transferable. Since I'm good at ... engineer, lawyer, businessman, whatever I am, I can do this because I'll be using this. Yes, some skills are transferable, but it's a completely different profession. Just because you're one doesn't mean that you'll be good at another. So people put some more money, they start taking trades on that basis, and they lose again, going into this continuous charity. Then people go into gambling because it accelerates. It continues accelerating. And the fourth step is conspiracy theory. Now, conspiracy theory means, the brokers are after my money, the government is after my money, high-frequency tradings are after my money, they're hunting my stops. But I tell you, they're not hunting your stops. And I can tell you this 100%, because they're hunting mine. Conspiracy theories, of course, they lack reasoning. For the simple reason is, I've heard people making excuses for losing trades, say, ooh, the broker is running my stops. But I have never made anyone make excuses for winning trades. I have never said, ooh, I made a silly trade, but the market went my way, and I made money, while I shouldn't be doing it. These conspiracies come always for their losses, not for people's wins. I mean, they lose by chance, but they don't win by chance. And how traders win? Basically, how traders win. So the mentality here of traders is that trading is like sex. You don't have to be good at it to enjoy it. How traders win? Well, in order for traders to win, they have to have some self-awareness. We have to create some self-awareness. And self-awareness is created with 4 things. Again, going back to how traders win. This is a famous, it's not mine actually, it's a coaching model, GROW. G stands for goals, R for reality, O for obstacles, and W for will. Now, I've adapted each and every one of these for trading. I mean, goals. What are your goals when you're studying? Do you want to become a full-time trader or a part-time trader? Because it's a completely different setup. both from an office point of view, from a strategist point of view, from a time of view, if you're going to be trading for income, or do you going to be trading for growth, or do you going to be trading for hobby? There's nothing wrong with that. I mean, I know people who are trading for hobby. They're losing money, obviously, but they're such so smart. They enjoy the excitement. So they're saying, okay, I'm not going to the horses. I'm not betting on football. I'm not doing this. It's just losing a bit of money on they like the excitement. There's nothing wrong with it. I'm not condoning it. Don't make a mistake, because it's a very conscious choice, both as what they do and how much they're losing over it. And again, today's presentation is why traders lose, so we'll be focusing on that one, how traders win. Obviously, we don't have the time to go forward with that one. So, we mentioned about 90% of the traders losing. Well, 50% belongs in this slot, in this part. And then some people go to the next stage if they develop some self-awareness. The second stage, the M. Actually, this is the trickiest stage because it's got actually 2 skills to master. The first one is S, self-awareness. The third one is R, obviously a skill beginning with R. T for the third. This one's got 2 skills to master. Let's look at the first one, the M. Well, what happens usually after, if people proceed? They usually go to forums and chat rooms. So they start discussing with others. I mean, what do you think of this market? Should I be doing this? So it's basically a game of the blind leading the blind. You're exchanging your views with people who are losing hand over fist. And each one is, sometimes the discussions on the boards are getting quite heated because they get personal about their positions. It's like politics or religion. And obviously, since that doesn't work, so they decide to switch markets. Oh, I'm not good at trading crude oil. As if it's crude oil's problem. And then, oh, I'll trade the FTSE. Maybe the FTSE will be more merciful to me. Obviously, that doesn't work, so they go into switching products. Products, okay, I'll go from Forex to binary options, maybe the switch broker in between. And they'll trade stocks, futures, whatever, the whole thing. Again, it doesn't have to necessarily happen in this particular order, but by and large, I mean, in an oversimplified way, this is what happens at this stage. Then they switch time frames. Time frames, suddenly they become investors because, the 5-minute chart is too much for them. They're losing at a very quick pace. Obviously, they want to slow this down. Suddenly they become, especially if they start keeping the loosening up the stops. Actually, there's a market, an exit order on that. It's called move when near. So when the market approaching your stop, they just move it, and again, they just move it. Switching time frames. So what people should do in this stage? They should develop market knowledge. Learn the ingredients, to put it in a cooking analogy. What is market knowledge? Because it's a general, broad term. What's knowledge? What should we learn? Okay, how traders win. First of all, I think we should be learning the what the market is. What the market does. And you can learn that through technical analysis. Again, each of these principles is subdivided into other 4 principles and other 4. So we're just touching this on the definitional basis. So when I say technicals, because it's a very broad subject, everyone is an expert in this and that. So my idea of technicals is learn about the trend. I mean, is the market moving up or down? But have tools for that. You will be amazed at how much your P&L would increase if you just cut out your buying for markets that are below the 50-day moving average. They were just in uptrend, buy uptrends. Momentum, how fast it's going, relative strength, and volatility. These are the core 4 tools of technical analysis. Then you go into the who. Who is doing to the market? Because markets don't move because of charts, because the XYZ oscillator went to 80 and you broke the trend line. Markets move for fundamental reasons. And you can see that through the Commitment of Traders report. Again, I don't have too much time to explain. Basically, it shows the positions of the big boys in the market. And markets move because of supply and demand, and people are buying it. And you can see who is buying it through that. Then you can go into the why. Why are the smart money moving this market? When I say smart money, I do mean from a conspiracy point of view. I'm talking about commercial users and commercial producers, for example, BP, are they buying crude oil? But they're not, they're putting it as part of their business, or are they selling crude oil? Or wheat for Kellogg's or any other firm. Intermarket analysis or fundamentals, basically the why. Why are they doing it? Why are they buying? And then you go to the sentiment, the when. Structural sentiment, when the market gets overbought from a structural sentiment point of view. Again, at this stage, you don't have to learn anything, but I'm just giving you the definitions of what you have to focus on. What's the reality, all right? No hocus pocus. So this is market knowledge. So supposing you have you've learned all that and you've got your market knowledge and everything is there and fine-tuned. What happens in these stages? People in this stage are not trading. They're gambling. They're throwing the dice. People at this stage, they're not trading. They're making trades. Okay? Here they lose big. Here they lose small. They're still losing, but it's on a cumulative basis, and that's how it comes to the 90%. So what can you do after the knowledge? For example, you learn the ingredients. Most people, learn about markets or learn about techniques and they would jump into the markets. But you shouldn't be doing that. Why is that? Because, yes, we may learn about the ingredients, but we also need, in order to cook, we need a recipe. Yes, someone said, we need a recipe. Learning what the flour, the butter, and the milk is not enough. We have to put this together. All right? So, what's the usual procedure that people do in the 90%? They usually buy, to start, again, it's an oversimplification, but I find it so many times, they buy ebooks. These $57 or $97, or they go to free seminars. I mean, they're trying to spend as little as possible. Now, usually ebooks, I've seen it, they come with these huge statements of, for $5.55, you can learn the secrets to the insiders of Wall Street. Or for $97, we show you how you can see how, the big money is running the show and so forth. Then they, obviously, they want to, open up their budget a bit, so they go buy technical analysis books or, fundamental, usually technical analysis books because it seems easier. And they start plotting things on their chart. The RSI and the stochastic and the MACD and trend line, so up until so cluttered, looks what I call as Christmas charts. Because everything is on there. I mean, there's so many stuff there, you really can't make heads or tails of it. Obviously, because that doesn't work, trying to figure out on your own, then you decide to go on the seminar. You say, okay, I can't figure it out on my own, books are not there, I'll go to a seminar. Now, I don't know why, but seminars, again, no disrespect, but usually people are attracted by the magic method mystics, as they call. People who explain perfectly the past, why the market bottom top there, why the bottom there. And these usually come in the form of like Elliott, Gunn, Fibonacci, or all sorts of things that explain to the accuracy to the T. Why the math? Of course, these are backward looking. There's no forward looking. But people are attracted because they're looking for easy answers. I mean, it gives you the assurance. Oh no, it seems like we know what's going on. Obviously, this doesn't work. So they go from let me do it, from show me how to do it, into do it for me. So they're going to buy expert advisors or trading signal services, and they'll say, okay, enough of it, no more analysis, I'll be following them. And obviously, no, I'm not saying that there are people who are not offering, have excellent books. Believe me, I have a very big library. I have bought courses, obviously not these ones, but or I wouldn't be trusting someone, but I'm just telling you there is a right and a wrong way to do it. Again, people are, losing throughout this whole process. And of course, the psychology, follows this pattern of losses. How traders win. All right, so what do you need to get out of this rut? You need a trading process. So one by one, we start seeing what we need. First, we need self-awareness. Then we need market knowledge, the ingredients. Then we put these together, the ingredients, into a recipe. And when I say trading process, I'm not saying a trading setup, and I'll show you the difference. First of all, a trading process starts at the strategic level. A strategic level is when you define you define your time frames, whether you'll be systematic or discretionary, and what levels of discretion you might be semi-systematic. Basically, all the things that are part of your character, and this should be transposed into your strategies. They're completely different than setups. You'll say, oh, we'll buy what XYZ indicator does this. So first you work at a strategic level. Then you work at a tactical level, which means after you have defined your time frames, this sort of like kind of dictate what tools you will be working on, if you're working on longer time frames or shorter time frames. So basically there are 4 types of trades, if you like trend following, reversal trades, retracements, and so forth. Again, we'll be talking about this at the workshop, but once you made the decision here at the strategic level, then you go into the tactical level. Then you go into the operational level. What's operational level? Well, a trade, if you look at it, if you like split it out, it's basically 4 components. One is the setup, I mean the conditions you should be looking to buy or to sell. S for setup. Then it's the signal, I mean where do I actually get in? S for size, position size, I mean how much will I bet on this signal? And the 4th S is for stop, your exit. So when you say, oh, I'll be having a trading setup, this is basically where you're coming up and you're skipping this part. And not to mention, you're using the last one, which is backtesting. Because yes, you may have a methodology, yes, you may have an idea, or you may be given one, but have you tested it? Have you seen how it works? Does it work for you? And this is how traders win at this level. Now, again, this is the part where we have to distinguish between inconvenient truths and reassuring lies. Because a lot of people don't want to be hearing this. They want to be hearing the easy and the fast way of making money, to skip through this whole process. Setbacks and characteristics for number 3. All right, let me make so we've make the decision. Actually, we want to highlight again the distinction between a process and a setup. A trading process is, we mentioned these 4 parts, and the trading setup is just, where you get in and where you get out. So you need the trading process. And the second thing I want to emphasize, and please, if there's nothing else that you get out of this presentation, is the following. Buying a trading course or a trading setup will not make you profitable. I repeat, buying a trading course or a trading setup will not make you profitable. The question is why? For the same reason that if you buy a treadmill, it won't make you slim. You have to work on it. It's the beginning. Unfortunately, it's been sold or perceived, depending on if you see it from the buyer's or the seller's point of view, as a magic pill solution. Oh, we'll buy this and we'll fix our problems. Like, have you seen the Matrix when he's given the blue pill and the red pill, and he gets the I think it was like the red pill or something, and the pill does the work for him? It doesn't work. There's no red or blue pills in trading. So this is what happens when you reach this level. Now, by now, this is 90%. This is the 90%. From level 3 and 4 is the 10%. So even people that have a trading setup, they have a trading process, and for the reason that I just mentioned, and they still lose. This is the 90% group. Let's see how we can get out of it. What do we need? First of all, is the need how to practice. So you need a demo account. Now, when I say a demo account, I don't mean it from the way it's been sold as a marketing trick. I'm talking from a point where you actually use it. Now, demo accounts are very, very useful when they're used correctly. Again, I'm saying not from a marketing point of view, to open an account, but I'm using it from a real view of having it. Yes, of course, it's not the real thing, but who cares? You get 80% of the experience with 0% of the risk. It's like being on flight simulator or operating on cadaver when you are in medical school. And so all the mistakes that you do will show up there. And like pilots say, it's much better to be on the ground wishing you were in the air than be on the air wishing you were on the ground. The second thing you need is how to monitor what you do, is basically your trading journal. I know most people don't use trading journals. They think it's too boring, but believe me, the trading journal is the most important book you will ever read. There's no technical analysis book, there's no methodology book you'll ever read as your own trading journal. Then you need to see the differences between your trading plan and your trading journal. So then is when psychology comes in. Now, there is a big misunderstanding. Oh, they say at the lower levels, I mean, slower stages, people lose because of their psychology. No, people lose because they don't know what they're doing, and it affects their psychology. At this stage, when people know what they have learned, they have started practicing, and they're deviating it from that, then they're going to look into it from a psychological point of view. It's no longer an issue of knowledge. It's an issue of why you're not doing it. Now you see it from a psychological point of view. And then, of course, ideally you must also have a mentor, because page 58 of the book will not tell you what you're doing wrong. And you need someone to point out these mistakes, point out solutions to the mistakes. We can't be both patients and doctors at the same time, you know. So, repeat and review. That's what the R stands for, the art of SMART. And I know most people don't want to go. They want to just go jump into doing hoops and making money. But and it lengthens the process. There's work. I'm sorry, I'll use a dirty word. There is work involved. Because I know everybody's here to make money easy, fast. But there's work involved. But I'll sweeten the pill for you. The work that is involved is enjoyable, because we're doing something that we are passionate about, at least in theory. At least the people have reached this stage. The gamblers have left at stage number 1. And if you start seeing the results, then that will start building confidence. Do you remember when we talked about the beginning of the presentation? How do you build confidence and discipline? This is how you build confidence. It's called RBC, repetition-based confidence. We're not talking about ego-based confidence. We're talking about repetition-based confidence, because you're doing it again and again and again. You're focusing on the skills, you're focusing on the drills that build the skills that pay the bills. Okay? Repetition-based confidence. You do it again and again and again and again. And then you get confident. Not cocky, not egotistical, but you're just very familiar. Actually, there is a technique called gradual desensitivization, if I pronounce it correctly. I was actually talking about it with a lady which I see here in the audience. Imagine you're watching a horror movie. Obviously, the first time you're watching it, you're taken a bit aback. Ooh, there was, like, say, a murder scene. But if you watch it 2 or 3 or 4 or 5 times, actually it doesn't bother you anymore, because you know what's going on. It's the same thing with trading. If you do the trades again and again and again, you've gone through the motion of having experienced a losing trade, and especially if you've done it on a demo account, under supervision, then you start building confidence. Because when you switch to the real thing, then it no longer matters to you that much, because you've already done it 100 times. So this is where you build confidence, repetition-based confidence. So at this stage, people will mention, think trading is like sex. At this stage, people are not traders, they are making trades. Right? Here they're throwing the dice. Here they're making trades. They're not very conscious about it. Here, yes, that's where trading begins. Part-time trading. Here you lose big. Here you lose small. Here you win small. And the last part of the setbacks and the strategies for number 4. Okay, so the question is, okay, how do we reach stage number 4? What's entitled? Again, I'll tell you that, I'll actually, try to, this screen is going. 50% of the market, the participants stop here. 40% reach here, probably more here than here. You've got another 7% around here, and the top 3% are here. And that's actually what's positive, because we mentioned about the 90% of traders losing money. Well, where does that money go? It doesn't vanish. I mean, they're not burning it. Yes, they might be, giving it charity, but actually, it's a wealth transference mechanism from here to here. So Wall Street and the City of London ends up being like Hollywood. You've got a large number of wannabe stars, but only a few actual actors who are making, I won't say the word, a lot of money. And this is how it works in the stock market as well. Because everybody goes to Hollywood to have an acting career. Most don't make it. But the Brad Pitts and the rest of them who make it, they make lots of money. And that's how it happens here as well. Okay, so repeat and review. How do you go to T? What does T stand for? Actually, this is my favorite stage. T stands for transformation. Because you transform your mentality from, I'm looking for a setup. I'm looking for the XYZ indicator to do this. I'm looking for ABC retracement of AD. No, you transform your mentality into these 4 what I call elite edges. Now, again, I'm drawing back from my experiences from the MTA and from my professional career. When you speak to people, not as private investors, but as on the institutional level, they've taken the trading in a different stage because they're looking at different things. And this is what I call elite edges. This is what professional traders look at. They don't look at the wiggles and the waggles and the indicators and the news and this and that. First, fusion analysis, amalgamating, putting together fundamentals and technicals. That gives a huge boost in your trading process. A huge boost. Whether you're fundamentally based and you filter trades with technicals, or it's the other way around. You're technically based, but you enriched with fundamentals. Now, obviously, because the next problem, because professionals lose as well. The next step, actually, elite edge, is position sizing. I know it's probably the least sexy thing one can talk about regarding trading. I know probably we can have a discussion about it, but half of you will probably fall asleep because nobody wants to know. What's there to lose? Just give me the signal and I'll put everything on that. And have you ever noticed? Actually, your position sizing, your capital, is like scuba diving. But these oxygen is to scuba divers. You have to be watching it that carefully. But people don't want to be talking about it because trading basically is the game where you're never satisfied. If you buy and you lose, of course, you're not satisfied because you lost. If you buy and then you sell and you win, but the market goes further up, again, you're still not happy because the market went up further. And then you buy at the bottom, you sell at the top, but you're still not happy because you didn't bank everything on that trade. So position sizing solves this problem. Then the elite edge number 3 is diversification. Now, there is one thing called degradation. When strategies stop working, nothing lasts forever. So what saves you here in this stage, because you may enrich the model, you've really taken it to the max through position sizing, but it may break. So diversification works, and diversification works in 3 distinct ways: either through time frame, you might be trading the same system in different time frames. Through markets, you might be, if you're not market specific, but you're technique specific, and you can trade, say, crude oil, bonds, euros, stocks, so you diversify across markets, or you can diversify across technique, which is the best form of diversification. I have different techniques uncorrelated to each other, and they complement each other, smooth out the equity curve. Again, this is something we'll be showing at the workshop how it actually works, but it's a magic. And then the 4th edge is humility. I would say knowledge-based, not having an know-it-all attitude. And actually, keep your eyes open for new ideas. Again, I'm drawing from the experience from the people I have met through the MTA. If you tell them, look, I have an idea of, they will always listen. They won't, oh, who are you? The complacency and arrogance is not a word in their vocabulary. Let me put it that way. And that's another characteristic, how you can tell a losing trader from a winning trader. Losing traders like to talk about their winning trades, while winning traders like to talk about their losing trades. Keep that in mind next time you hear someone talking about markets. And again, we're going to transformation. And I think with that, we'll probably wrap the whole thing up. And one small note. Obviously, for time, pressure of time, I can only go into very briefly why traders lose. Again, I'm going to expanding on these ones and go into why traders win other than a definitional basis. XTB invited me to give a workshop on, on how traders win. It's free of charge. You don't have to open an account. You don't have to put any money. You don't have to do anything. You're just speaking to the gentleman at the back, Eric. And the thing is, I have some good news and some bad news. From the discussions I've had with Omar and Eric, because there was already demand, we'll be running the same workshop twice. It will be the same, so you can pick a date. One is on the 8th, and one is on the 15th of March. Again, there is no catch. You can, it's free. And but priority will be given for those that have accounts. Again, it's not my issue. It's how XTB chooses to handle itself within the people that will be coming on the workshop. I just felt the need to say it. Again, transformation. This is we'll be going through all these stages. And another thing before we part ways, you were all given, hopefully, you have a feedback form, which I hope you will be filling out and share your thoughts with me, what you thought of the presentation. It's not a marketing trick. I really want to know your thoughts, and hopefully through that, I can brainstorm and add material to the presentation or shift it in a different direction, because I really want to be communicating, because these presentations are about communication. So if you please fill them out. Now, and return them back, I can invite you. Sorry? Yes. When you return these, I will get you to invite you to the next MTA chapter meeting, so you can see institutional level presenters. And I'm sure you can. I saw about 5 or 10 hands raised of people who attend UK chapter meetings, the MTA meetings. So please do return. And also, additionally, Alex Elder sent me his book, The Trading for Living, the new one, to do a book review. And I actually was a bit lazy about doing it. So he sent me the book, and I told him I'll do it over the summer. And over the summer I was on holiday. I was taking photos of the books on my holidays, and I was sending it back, and he was laughing. But I haven't gotten around to do it. But I thought this would be a good opportunity, because there will be more people here. So send me back the feedback form with some comments and your details, and I'll make sure you attend the Alexander interview on his book review. Again, it's his book review. It's not mine. And some parting thoughts. I really hope I'll see you again, whether the workshops at the MTA or maybe at the next masterclass, if XTB is stupid enough to invite me again. But in any case, I really do hope you make the right choice. Actually, you make a smart choice towards safe, confident, and disciplined trading, and also enjoyable trading. Because at the end of the day, trading is not just a profession, it's also a lifestyle. Thank you very much.